Renita Young is in the newsroom. Stand by with the numbers and a big success story here. The year of efficiency, the cuts paid off, I guess, Renita.
They did, and it was so successful that we finally heard an update on the metaverse, just like Kevin talked about. So shares are higher for Meta on earnings and revenue that beat. This morning we have tons of analysts coming out raising their price targets on this stock and issuing upgrades and proving that this year of efficiency that Mark Zuckerberg started has been working like a charm. Adjusted earnings came in at $2.98 a share. Revenue grew 11% to $32 billion. Research and development and general and admin expenses grew substantially during the quarter, while marketing and sales expenses contracted. CapEx expectations for next quarter actually came in lower. I'll talk about that in a moment. But daily active users grew to 3.07 billion. That was above the expectations. So were the monthly active users, coming in above expectations. Ad impressions grew for the quarter. Now, looking ahead for the third quarter, the company is projecting revenue between $32 billion and $34.5 billion. That's at least a 15% increase for the quarter year over year. And Meta, however, is lowering its 2023 capex capital expenditures expectations, and some analysts are wondering if this could be trouble specifically for NVIDIA as the company tries to do more of its work in-house.
That's right.
As it tries to bring chips in-house. And more on that, Bank of America, while it boosted the price target this morning to $375 from $350, it mentioned that the company does have a strong real strategy and it's gaining market share, but that reduced capex is concerning, and it might be concerning through the 2024 year. Now, Morgan Stanley says Meta's now in its AI glory days, and it talks about how that AI-driven engagement and the revenue beat and raise came from the AI-driven engagement. They chose to maintain an overweight rating and raise that price target to $375, which represents more than a 22% move to the upside from where it closed on yesterday. So we have a lot of positivity coming from it, with that one shred of doubt coming through the capital expenditures number projection for 2023.
It sounds like that might even apply more to the chip maker that's supplying to than Meta itself. All right, so market loves it. On the flip side, though, market having second thoughts about Chipotle, which was kind of surprising to me. Shares down. I guess 7.5 comps isn't good enough anymore for this stock.
I guess not. Well, you have to look at the whole picture, because this company fell short on sales, even though earnings, it went way past expectations during the quarter. Adjusted earnings were above at $12.65 a share. Revenue grew almost 14% to $2.51 billion. That was just shy of the Zacks estimate. Comp sales definitely grew, just as you said, 7.4%. Labor expenses and SG&A expenses grew as well, and the operating margin did expand for the quarter. Now, the company has a total restaurant count of 3,268. It opened 47 new restaurants in the quarter, but analysts had expected Chipotle to open 57 new restaurants. So many are wondering this morning why the slowdown. And also, while the prices of avocados were lower during the quarter, prices for tortillas, dairy, beef, and other ingredients that go in your Chipotle burrito bowl did rise during the quarter, and that put some pressure on profits as well. But looking ahead, the company reiterated its full year forecast for same-store sales growth in the mid to high single-digit range. And for the third quarter, they're expecting comp sales to grow in the low to mid single-digit range. But this morning, analysts are cutting their price targets for Chipotle. TD Cowen cuts it to $2,200 from $2,350 with an outperform rating. Wedbush Securities and KeyBank both cut their price targets to $2,200 as well from $2,300. Wedbush has an outperform rating and KeyBank has an overweight rating, and Oppenheimer has a buy rating with a $2,300 price cut.
Okay, so price of guac came down. but don't think it showed up on any of my Chipotle bills. 7.5% comps. I mean, it sounds like they are kind of shifting some of the expectations to lower into that range with mid-single digit. Now, something I guess investors are going to have to get comfortable with. The screaming growth days from a couple of years ago have come off a little bit, but all right, still obviously cranking out consumer staple supply of food here as they keep adding more stores and the count is going up. But yeah,
working.
A little shy of what some of the analysts thought about as we talked about yesterday. So they're going to have to pump up the volume, I guess, to make up for slower comps. Thanks, Renita. Appreciate it.